Okay, welcome back for our last module of the financial empowerment classes. So this module has lessons 5 and 6. We're going to talk about insurance and investing. So we are just going to get started. So we have a couple of definitions. These pretty much are all across all types of insurance. So first we have your deductible. So that is the amount that you pay out of your own pocket before insurance kicks in. So you have that with medical, car insurance, home insurance. It's pretty common with all insurances where you have to pay, a certain amount before the insurance will start paying. You have your premium, and that is the amount that you pay every month to have insurance. It's basically just the cost of being able to use the insurance, right? So every month you pay your premiums. They do not count towards your deductible. So you have your premiums every month. And then when something happens and you need to use your insurance, you have your deductible that you pay first, and then insurance will start kicking in. With medical insurance, you have a copay, and that is a set amount you pay medical providers when you receive services. So if you go to just your family doctor and you're just getting a checkup or something, maybe you pay your copay. That's like $20, $25, just depending on your insurance. And you pay that, when you go visit your doctor. That also does not count toward your deductible. And then we have co-insurance. So that is the percentage of the claim that you pay under a health insurance policy. So how it works is once you hit your deductible, then you will start paying your co-insurance. So after you've paid your deductible, insurance will start paying. And usually at that point, they only start paying for part of your expenses. So usually it's like 80% they'll pay, and then you still pay 20% of whatever services you received. So like if you have a baby, you pay up to your deductible, which depending on your plan, we'll say is $4,000. You pay those $4,000. And then insurance will start covering 80% of the things that you need from then on. And then you have your out-of-pocket maximum. And so that's the absolute maximum amount you can pay in any given year. Okay. Home insurance. So we're going to start with homeowners insurance. The basics. It covers damage to the interior and exterior of your home. And so that can be from many different things. There are a few things that in general are not covered by your home insurance. So damage from a flood, earthquake, or just not taking care of your home is usually not covered. So you can often buy add-ons or what they call riders to cover these things. So you, especially, if you live in Salt Lake County, you probably want to get an earthquake rider on your home insurance policy because sometimes we have earthquakes, and that will cover you if you have that rider. Flood insurance is only actually available. There's a government agency that provides flood insurance. That's the only place you can get it. And you have to be in a government declared flood zone. So if you live near maybe like a lake or a river or near the ocean, obviously, most of those would be considered flood zones that you could get flood insurance through, but you can only get that through the government agency. Home insurance usually also covers your possessions. So it's always a good idea to have kind of an inventory of what you have. You can just take like a video of your home, and that way you have proof for the insurance if something happens. They can see that you had it in your home. And they also have what's called personal liability insurance on your home insurance. So that is for damages or injuries. So that's like if your dog bites someone or someone breaks their ankle while they're jumping on your trampoline or something like that. That can be covered if they try to use your homeowner's insurance. So most of the time they recommend at least $300,000 of coverage for personal liability because, if you have medical bills to pay for someone else, that can be pretty high, right? Home insurance also often will cover a hotel or a rental while your home is being rebuilt or repaired. So if, your home is damaged in a fire, your home insurance will often pay for a hotel, a rental, something for you to stay in while your home is being repaired. So that's kind of the basics of what home insurance covers. Obviously, there's a lot more I could say, but I try to keep this relatively brief. The next one is renter's insurance. So it's very similar to homeowner's insurance, but it's for people who are renting. So it covers loss or damage to items in the home or apartment due to like fire, theft, or if there's issues with plumbing, things like that. So it mostly covers your possessions. It's usually really cheap. Often you can bundle it like with your car insurance. I think I pay $9 a month for my renter's insurance. And that will cover, like if someone comes in and steals my TV or something, it will cover it. And with homeowners and renters insurance, you do want to remember that you do still have a deductible. So you pay your monthly premiums. And then if something happens and you need to report it to them, say my home is damaged in a fire, I still have to pay up to my deductible. And usually you can choose your own deductible. So for a renter's insurance, maybe it's $500. If something happens and it's going to cost me less than $500, I'll probably just pay it. If it's costing me more than that, I'm going to make a claim. I'm going to pay my $500 and then the insurance will cover the rest. So renter's insurance is always a good idea to have. Next is car insurance. So car insurance is 3 parts. So you have liability insurance, physical, and medical. So liability insurance is required in Utah. Liability insurance covers other people if you were the person that causes the accident. It's shown as 3 numbers. You'll see it here on the second bullet point, 25/65/15. So that is what is called the Utah minimum for liability insurance coverage on your car. So the first number is how much your insurance will pay for bodily injury to a person per person. So the Utah minimum, $25,000 per person, your car insurance should be covering that if they have harm to their body from an accident. The second number, so the 65, is a per accident for bodily injury. So meaning they'll pay up to $25,000 per person and up to $65,000 total for that accident for bodily injury. So if you have, 5 people in the car, they all have a $10,000 medical bill. Okay, your insurance will cover it at the Utah minimum. If you have 7 people in a car and they all cost, $20,000 or something. Now, obviously 7 people in a car is a lot, and most cars probably don't hold that many, but 7 people times $20,000 is way over your minimum. And that's kind of where some problems can arise. We'll talk about that a little bit later. So the third number in that is 15. And that's a per accident for property. So that is what your insurance will pay out for damage to like the other people's cars. Now the Utah minimum really is pretty low. If you think about it, if you get in an accident on the freeway and you end up hitting 3 cars, it's very likely you're costing more than $15,000 in damages to that car or to those cars and to the people in those cars, right? So that is the absolute bare minimum you have to have in Utah to legally drive your car around. The recommended coverage is 100, 300, 100. That's obviously going to cost you more in your monthly premiums, but that will cover $100,000 per person for bodily injury, $300,000 total per accident for bodily injury, and then $100,000 per accident for property damage. And that can cover a lot more than the Utah minimum does. The next thing that is required is personal injury protection. That's called PIP. The Utah minimum of coverage is $3,000. So that will pay for your own medical expenses in case of an accident. So it doesn't matter if that accident would be your fault, the other person's fault. Your PIP, personal injury protection insurance, will cover $3,000 of any medical costs that you have, and then your health insurance kicks in. The next one is uninsured/underinsured motorist coverage. This can be really helpful. It makes sure that your losses are covered if somebody who is uninsured or doesn't have enough insurance, if they cause an accident, you're still covered by your own insurance. So this is an important part. Obviously, the more things you add on like this, the more your monthly premium will cost. And sometimes all we can do is, the Utah minimum. But that's a great idea to have, just in case someone who doesn't have insurance and is driving their car illegally causes an accident and they can't cover you. So it's a really good idea to have that. Excuse me. Collision insurance pays for damage to your car caused by another vehicle, an object, or like a rollover. So if your car were to, roll over, you didn't hit any other cars, nobody really caused it, like maybe the roads are slick or something, collision insurance would cover that damage to your car. Or if this happened to me, actually, I was driving on the freeway between Idaho and Utah. A brick, I think, fell off of somebody's truck and hit my car. So that would be covered by collision insurance because the thing hit my car, right? The next thing we have is comprehensive, and this is something, comprehensive car insurance will add the most to your premium. And that pays for damage to your car from things like fire, or if someone breaks into your car, or if it's caught in a flood. So it can be really helpful if you're worried about something like that happening. If you have an older car, it might not be worth having to save on premiums, this specific comprehensive coverage. My husband, when we got married, he had a 1995 Subaru. It was worth like $900. So we did not have comprehensive coverage on it because I think our deductible for our car insurance is $1,000. So it just didn't make sense to pay that premium if we were going to have to pay $1,000 deductible anyway. And that was more than the car was even worth. So it just kind of depends on your personal preference. We have, newer cars, 2013s now, which we do have comprehensive coverage on because they are worth more than, our deductible. So that one's kind of individual, but keep that in mind if you have an older car that, the deductible may be even more than what your car is worth. It probably is not worth having comprehensive coverage on your car. Okay, next is health insurance. Health insurance is, there's a ton of stuff that goes into health insurance. So we're just covering the very basics. So health insurance has a deductible, which we talked about before. It's the amount you pay out of pocket before health insurance pays its share. Your copay is the fixed amount you pay at the time you receive service. So oftentimes, like I said before, at a doctor's office, or if you go to like urgent care, you'll have, maybe a $50 copay. So those are things that you'll be paying at the doctor's office. And then we have traditional versus high deductible insurance. So it's kind of self-explanatory with the name. Traditional usually has a lower deductible, so maybe like $1,000. So that's what you pay before your health insurance kicks in, and the premiums, the amount you're paying monthly is usually higher for those types of insurance. High deductible plans, on the other hand, will have a much higher amount you have to pay out of pocket before insurance covers anything. So maybe $5,000 to $6,000, and those will cost you a lot less per month. Because you're taking on that bulk of the, $5,000 to $6,000 before the health insurance kicks in. So if you don't get sick a lot, or, you don't really use your health insurance very much, high deductible plans can be really great if you have the funds to pay for that deductible if you need to. Otherwise, traditional is also a great option. I talked a little bit about this before, out-of-pocket max. That's the maximum you can pay per year for medical expenses. And insurance, after you hit that number, will cover 100% of everything you do in that year. Out-of-pocket max does include any copays that you pay. It does not include premiums, so that doesn't count for the calculation into your out-of-pocket maximum. So yeah, once you hit that number, you don't have to pay anything except your premiums for the rest of the year. Life insurance, we won't get into this too much. Term life is usually the best option for most people. It's usually also the cheapest option. You can often get it through like your job if you work full-time with benefits for even cheaper. These are called term life because they only last for a specific term. So 10, 15, 20, 25 years, or, if you get it through your company, just as long as you work there. And that's also why they're kind of cheaper. Whole life, you pay premiums and you're covered for your entire life. So you're paying premiums all the way up until that insurance pays out when you pass, right? Usually it's the most expensive type of life insurance. Oftentimes you'll see life insurance salesmen trying to sell this because they get the most commission from it. But most of the time it's not the best option. Okay, so that's all about insurance. We're going to move on to lesson 6, which is saving and investing. Okay. All right. So saving at the bank. There are some things we can do at the bank that are great options for saving. So your emergency fund, that's the most important thing of your savings. So you want to have 3 to 6 months worth of living expenses saved in your emergency fund. And we keep that savings in a savings account at the bank so it's easily accessible and FDIC insured, meaning it's always going to be there. You won't lose money. You'll always be able to access your money. Doesn't matter if the bank goes under, it's FDIC insured, and that's a government entity. So they will make sure that you get your money. The next option is certificates of deposit, CDs. They provide an interest rate in exchange for leaving your deposit untouched for a predetermined amount of time. You can get them for short periods of time, 3 months, 6 months, up to a year, up to 5 years. For these, you want to shop around. All places will have different rates. So credit unions usually have better rates than banks. Sorry. So usually they're the safest form of investment. You're not going to lose your money. You'll get paid out your interest rate at the end of the term. They're really low risk, not going to lose your money. So go along with that, right? We have a low risk, which means we have a low reward. Interest rates are usually pretty low on CDs. But if you're looking for no risk, they're a great option. If you don't plan on using it, they're great for money you don't plan on using for a while, but you don't want any volatility. So meaning you don't want to take any risk with this money, but you don't really have a plan for it for a little while. These are also FDIC insured. So if the bank shuts down or something crazy happens, the government does guarantee this money. Next thing we have is a money market account. That has a higher interest rate than a savings amount. Savings account. So an interest rate when you're investing means that they are paying you to keep your money with them, right? So usually it's a little bit higher than a CD, easily accessible. You can pull money in and out of there. You don't have to lock it up like you do with a CD. Interest rates can change, whereas with the CD, it will stay the same for the whole time that you have the CD. And they can require a minimum balance. So those are some really good options at the bank, all pretty low risk. Next one is just investing, right? So we have stocks. Stocks are basically as if you were buying a small piece of the company that you're buying. So if you were to buy an Apple stock, it's basically like you having a very small chunk of Apple that you own. When we talk about stocks, risk return is really important. So kind of like we were talking about before, if we have low risk, we have low reward. If we have high risk, we have high reward. So in general, bigger companies are a safer investment. They're more stable. Small companies are more risky. So if you're looking to invest and this money isn't super important to you, but you just kind of want to see what happens, you can go for the higher risk. If it doesn't matter if you lose your money, it doesn't matter, right? But most of the time we like to play it pretty safe, right? Then we have bonds. So a bond is a company borrowing money from you that they'll pay back with interest. So it's basically like you're the bank where they're borrowing money from you. Generally, it's a pretty safe investment. They don't fluctuate as much as stocks. And bonds are rated. So they can tell you which is more risky. So they have different ways that they look at the company. If it's a company that's their financial state is looking kind of iffy, it'll be a little bit more of a risky bond. But there are many bonds out there that are really stable that can be a good investment for some people. Now, most of the time, you're not going to be buying individual stocks and bonds. You will be buying a mutual fund. So this is what most people use. It's the easiest way, I think, for people to invest if they don't have a lot of experience. So it can be a basket of stocks or bonds, or it could be a basket of both. Where you have this company that's managing the mutual fund. A lot of people are paying into that, and the company is using that money to buy many different stocks and bonds. So you just own little chunks and little slivers of those stocks and bonds, all bundled together. So retirement plans often offer what are called target date funds. They adjust to be less risky over time as you get closer to a retirement. Those are really great options if you want a really low maintenance investment in your retirement plan. Basically, when you're younger, your target retirement date is, let's say, 2065 or something like that. It'll be more risky when you're younger, and as you get older, it will get less risky. Okay. Some things to think about with investing. What are your goals? What's the most important thing for you? Is this money going to be in here for long term, like for retirement, or is it short term, like I want to buy a house in 5 years? Those are things we need to take into account because if it's in there for a longer time, we can afford to take a little bit more risk because there's more time for recovery. If it's in there for a shorter time, we don't want to take as much risk because there's not as much time for recovery. Another thing is, how does taking risks with your money feel to you? If you're going to be really on edge and really stressed about it the whole time, a really risky investment is probably not for you. So we want to take that into account. The biggest thing, though, I would say, is take advantage of your work retirement plans if you can. If you work a full-time job with benefits, invest in your 401k, add money to it. That's probably the best and easiest way to invest if you have access to that, obviously. Now, investing is way more complicated than, just what we talked about. But if you have questions, you can always email me. I'm happy to kind of walk you through if you have specific questions. But that's just kind of the basics to kind of get you started. So that is actually the end of our financial empowerment classes. Again, if you have questions, please contact me. I'm always happy to help you out. And thanks for watching.